News in-depth coverage now on the growing financial crisis.
I think this is the most significant financial crisis in the post-war period.
Excuse me, sir, how are you feeling?
How do you think?
The 2008 crisis was one of the big market shocks in my entire career. You never know how good an advisor is until you have a problem. If the market's doing nothing but performing, anybody can be a great advisor. It's when we have challenges. It's when we have to encourage people to hang in there. Unfortunately, you have to learn that stuff the hard way. You have to take your lumps. So the tech bubble bursting in the spring of 2000, that's where we've got this newfangled thing called the internet coming. And all of the companies are promising returns, but they don't have returns yet. These companies were IPOing and they were skyrocketing in value. But you know, today, where's egghead.com? It's long gone, never even surfaced. So many of these companies that blew up off arbitrary forecasts, they just didn't see the light of day or they failed quickly.
Like the steam engine which sparked the Industrial Revolution of the late 1700s, the internet is changing everything it touches. And at the cutting edge of the revolution is Wall Street.
So we are now 6 3/4 points above.
The market tanks in the spring of 2000 because of the tech bubble bursting. It's starting to come back up, Matt. Then the next thing you know, Twin Towers get smoked.
And you're looking at the World Trade Center. We understand that a plane has crashed into the World Trade Center. We don't know anything.
That's the second market shock in my career. How do you account for terrorism? So then we climb back out of that hole. And it takes time, effort, and energy until 2007.
Weekly jobless claims hit a 26-year high. With fewer people holding jobs, fewer can make their mortgage payments.
A lot of people think the financial crisis is 2008, 2009, but I will tell you it started in 2007 because we were transacting almost exclusively in Fannie Mae, Freddie Mac, and Ginnie Mae securities. They enjoy the implied AAA rating because they're part of the federal government. When we went through the financial crisis, that was a big lesson on looking another layer deep.
The recession that almost crashed the U.S. economy was precipitated by the bad behavior of some of the biggest Wall Street banks.
So the financial crash, no longer were they doing these refinance loans, especially these were like, they called them the ninja loans, which was like no income, no verification, no nothing.
How could we have ever known that the people that were issuing loans that backed these securities were what they called ninja loans? No job, no income loans. They were literally just giving people out loans. They were having loan approval parties in hotels. They weren't even looking at income. They weren't looking at anything. Your job was just to rubber stamp loans and sending them down the pike to be financed and houses put in place. I think the big grab was the banking system that were getting paid big dollars to finance loans. And they were just turning a blind eye.
And that's why 2008 happened.
Yeah,
right?
that's why it happened. Yeah. You know, I was part of it. I was selling houses where these guys were doing...
You made some good money off of it, huh?
They were doing these ninja loans.
When the market dropped, people were just essentially taking the keys to this new house back to the bank and just handing it to them. The dude that unraveled that was literally driving to the addresses of these houses, and he was identifying homes that had been moved out of. And then he would find that address and it would be part of a collateralized mortgage obligation. And he would be like, oh my gosh, 17 of these homes are already in foreclosure. Well, the investor on the other end doesn't know that stuff. He's just sitting there thinking he owns a AAA rated investment because it is partially owned by the US government, Fannie Mae, Freddie Mac, Ginnie Mae, these institutions. He's thinking he's got the most secure investment in the world. Internally, a big chunk of that's already been foreclosed on. And the banks were making all the money because they get fees to write loans. So they were getting rich writing bad loans. The investor ended up taking it on the chin because they're thinking they're buying investments that are AAA rated, the safest rating you can have. And the whole thing folded from the inside out. The same big banks that were writing the bad loans are then getting bailed out by the federal government to stay in business because they have to, or the banking would have failed in the US too.
There are several kinds of people who borrow money from banks. For simplicity's sake, we'll use a grade system from A to F. A being the highest mark, with F being a fail. If the borrower has an A grade, banks fully trust the person and expect him or her to pay off the loan.
You had people that rate bonds. Financials are solid, so we're going to give that a AAA. Or they're doing a municipal bond for a new swimming pool and their community has great financials. We're going to give that a AA rating or something like this. Well, after the financial crisis, they went back through all of the bonds in the United States of America and re-rated them. So now you've got a client that might own a $100,000 AAA rated bond. It just got re-rated as a BBB. Now it's not worth $100,000. Now it's worth $81,000. People don't remember that after the stock market got smoked from the financial crisis, when they re-rated all the bonds in America, that market got smoked as well. That's when, if you're a financial advisor, you're having a gut check as to whether or not you want to stay in this business or not. It was an ugly time. One of the true market shocks in my career.
It does mean that we're starting to right some of the wrongs we created over the past couple of decades, but it's going to be very painful.
Very painful as Americans slowly try to shake what's likely to be the longest recession since World War II.
What happens to a financial professional when them and all of their colleagues are dropped?
It's crazy. You're scrambling for a new place. You're scrambling for a new home, but also you're responsible for all your clients. So you're searching for a home for all of your clients.
Did you find a home for all those clients?
I did.
Dude.
I did. Nobody's absolutely thrilled about anything that's going on. And you have to introduce them to a new home, a new place, a new way of investing. This is very challenging.
Okay, now I got another crazy question. Do you still have any of those clients?
I absolutely do. And one of them in particular, I said, you know what? I work really hard. I think I'm just going to go do something different. I'm like, if I can't trust the federal government to put a AAA rating on this type of investment, if that's where my due diligence has taken me, I'm just going to go try something else with my life. And one of those clients said to me, you know what? You need to figure it out. You need to stay here and you need to figure out something different. And so I did. My name's Shane McCann and I own and operate the Montana Retirement Income Advisory. And I developed this whole plan, and that's what evolved into the Montana Retirement Income Advisory, where we use very safe, insured products for income, and then we use pure stock market plays for growth. That's where I found myself. Experience is what you get when you didn't get what you want. And man, that's what the financial crisis taught a lot of us. It just creates a drive inside of us to do one more layer of due diligence, look a little bit deeper, understand what's behind what you're being told.
Fast-breaking developments in the coronavirus emergency in the U.S. and around the world. The number of cases soaring just today.
Any place people congregate is a place where coronavirus can be spread.
How does an advisor in Missoula, Montana, prepare for a pandemic of all things? It's virtually impossible. You have to have people positioned correctly before it happens, but then you also want to make sure that when something like that happens, you're doing enough hand-holding, encouraging, research to try and identify where the recovery cycle is going to begin and how long it's going to run. It's about planning for the future and planning for the possibility that we'll probably have another market shock in the lifetime of our retirees. The tech bubble bursting in 2000, the Twin Towers getting hit in 2001, the financial crisis in 2007, 8, and 9, and then the pandemic. What I've learned is, and the biggest thing I want to impress on people is, the only way to handle those situations is to be prepared before they happen, to almost expect that we're going to have another market shock, and to have downside protection on your investments, meaning that when the market falls, you won't incur the entire loss that that falling market brings. It's going to happen again, and we're going to have people prepared for it. It's what our entire practice is built around. Protecting retirees from losing money, and at the same time, trying to make remarkable gains.